Okay. First, I would like to welcome you to our strategies for savvy banking today. It is one of our newer courses, and so we're excited to launch this today. And I hope you enjoy. I'm pretty sure you will because we have lots of valuable information for you. I want to let you know that we do have other classes. Before we get into the presentation today, I kind of want to give you a few updates. So we do have a full list of homeownership and financial literacy classes. I will put the link at the end. So if you want to check it out, there is a website where you can register for all of the classes that we have, including for today's class, which is you already probably have access to. More will be added soon, but you must register to attend all of the classes. They're all free, and this class is definitely great for my homeowners. This is an interactive class, so feel free to raise your hand, or if you have questions, you can feel free to, just kind of jump in when you can, or when you feel motivated to. Okay. So without further ado, I want to go ahead and introduce today's guest. I'm so excited. But before we get into it, I want to take a moment to welcome Lauria Grant III. He is a business services representative with First Citizens Bank. Lauria brings over 20 years of experience in the banking industry, and he's made it his mission to help both individuals and businesses not just manage money, but make it work smarter. His approach is all about real relationships, personalized strategies, and creating financial game plans that actually make sense. Lauria isn't just a robot. He's not, someone you're going to call and get an AI bot. He's a real person and he treats all of his clients and customers the same way. He's worked with people in all stages of life and business, helping them optimize cash flow, improve their credit, and map out financial goals that lead to real results. He's known for his consultative style, integrity, and dedication to service. And when it comes to banking and financial tools, Lauria doesn't just talk the talk, he lives it. Now, let me tell you how I met Lauria because the connection was literally meant to be. We met at a Brandon Chamber of Commerce event, and as we got to talking, we realized something, pretty wild. Like, I actually knew his wife. She was a director back when I worked in the tax department and an accounting firm. So this is like small world, right? So when I say this man comes from a financial savvy household, I mean it. And that's exactly why I knew I had to bring him here today to teach strategies for savvy banking. Lori is about to drop some real gems that I can actually vouch for. He's helping me in some of my, financial strategies and things of that nature. So definitely get your pen, get your paper. You need to take some notes, write down all your questions. Feel free to ask your questions because you got to get ready to learn how to make your bank world or bank work for you. So, Loria, uh, take it from here. It's all yours.
Wow, wow, wow. Oh my goodness. What an intro. Royce, you're too much. Thank you so much. And
Yeah.
it's an honor to be here to basically get plugged into your network, Royce. The vision that you have for really bringing financial literacy to the masses um, at this kind of level is really inspiring. I could not say no to you at all as it relates to this. This is a passion of mine for a couple of different reasons. One, of my own personal financial journey of dealing with very challenging financial situations, including job loss on different times in my career, as well as also observing family members and friends go through the same thing. And then having more of a shepherd's heart to ultimately help people not just on the tactics because that you can find everywhere online, but the human touch of what you actually go through emotionally, spiritually, even physically, all of that actually coalesces together and causes people to really deal with a lot when they're going through their financial journey. So my goal here is to kind of hit on some highlights of some key things that we know that successful individuals and families do to ensure that their banking experience is really a good one. And then also making sure that the bank is serving their interests, but understand that it is not a situation where you go to the bank, you ask them to fix everything for you, and then that's how it goes. It is truly a partnership when you get into the right ecosystem. And while a checking account, a savings account, a credit card, and any other financial tool can be basically the same no matter where you go. What you'll find is that the actual real relationship and the vulnerability that you share with whoever you decide is your trusted advisor, that is actually what causes amazing results to happen when you're in true partnership with someone that is looking out for your best interest, helping you navigate the tools and the resources that are out there, and then ultimately celebrating every small and big win that you experience along the way. So with that, I'll pivot and share my screen so that way we can get into the presentation.
And Lauria, just so you know, Candace, she's one of my newest homeowners. She literally bought her house less than 2 weeks ago. So she's exciting.
Ooh, okay.
Yes.
Congratulations.
Mm-hmm.
Thank you.
Okay. Is everyone seeing my screen okay?
Yes.
All right. All right. So this is a intro to savvy banking, banking for families. Now, before I launch into the meat and potatoes of the material, I want to give a special shout out to my employer, for Citizens, for giving me the platform to actually discuss and really dive into my local community like we're doing here in order to really bring financial literacy to our community. And because we're virtual as well, I know that it will go far and wide. So I'm going to give just a couple of highlights about First Citizens Bank before we enter into the presentation. Okay. First Citizens Bank is a bank that has stood the test of time, based in Raleigh, North Carolina, 125 plus years of experience, starting as an agro bank in that area, and then ultimately becoming a nationwide bank. Now, a bank is a bank to most people, but one of the unique value propositions that we offer is the fact that we're actually family controlled. Family control, what does that mean? Well, family controlled means that the idea of what the vision of the bank is actually tethered more to what the holding family who established the bank originally generations ago. They're actually the DNA of the bank, and they look for individuals and partners in the local communities that they serve to get along that plan and that path. So similarly to how we here in this presentation are talking about how we can actually bring value to one another through savvy banking, as an employer, they're helping me become more savvy as well as a banker, based on how they do things. And one of the beautiful things about us is that we have the scale to compete with anyone. However, we don't have the attitude because the family's DNA is truly to be community first and community focused, where we're putting our clients forever first. Uh, Royce already kind of gave an amazing introduction, so I won't go over too much more there. I will say though that I have a little bit of a unique experience, being born to immigrant parents and also being born in Jamaica originally and moving here at the middle school age. So I've been able to actually understand, kind of as an outsider perspective, um, how banking and how finances work here in the USA versus in the Caribbean, for example. One of the things that I've also been blessed to do is to have led my family, which I have my wife and two boys. Royce mentioned my wife earlier, and we are here in the Tampa Bay area, and it's just a joy and a blessing to lead my family, and that's what actually makes my helps my purpose really live out, and why I'm even here today. So let's dive in. So earlier in my intro, I talked about some of the key elements and traits that we find with families that have a great banking experience, are tethered to some of the topics here that are listed. One of the things that I want to focus on are living below your means always. It sounds simple. It sounds, automatically like, oh, okay, sure. But in actuality, when you're actually making that individual decision moment by moment, you're making tens of thousands of decisions over your life to ultimately live below your means. Now, I'm not talking about perfection when I talk about living below your means, but you have to have a mechanism, an infrastructure, an environment that basically helps you understand that when you're on track, it should feel a certain way. And when you're not on track, it should also feel a certain way. So, some of the ways that you can actually make sure that that's living and breathing in your life is making sure that you're talking openly with your close circle about money. It's really shocking that a lot of people will literally be radio silent with those they're most intimate and closest to when it comes to the topic of finances because it's such a difficult thing and it causes to stir a lot of emotional responses that may or may not be pleasant. So because of that, making sure that you're in that place where you can really get kind of the full meat and potatoes on the table about all of your money habits, your goals, your aspirations, your dreams, your fears. All of that needs to be done in order to ultimately create that ecosystem that then allows you to thrive. The other thing is, making sure that you have a working financial plan. Again, sounds simple, but I'm gonna share some data with you in the next couple of slides, and you'll be shocked at how many folks do not have a financial plan. Now, a financial plan doesn't have to be super complex or complicated. It could literally be as simple as knowing exactly what comes in at the beginning of the month, identifying what your needs are versus what your wants are, and then just making sure that you do not violate the rules that you come up with as it relates to how you want each month to go. It could be even more complex, obviously, as you add more, complexity to your life. Whether it's getting married, starting a family, supporting aging parents, for example. There's just so many different things that will happen in your life that you'll need to make sure that if it's simple or really complex, a plan is ultimately going to be the foundational thing that helps you see your goals and your milestones through. Okay. Uh, Practicing financial discipline is also key, but discipline can't come without structure. So I can, get into all kinds of different details around, oh, your net worth, and you have these savings milestones, and hooray, we purchased a home, which is great. All those things are absolutely amazing. But what underpins your ability to do any of those things comes down to the practice of the financial disciplines that you have to reach and hit those milestones. And then also being resilient when tough times come, because let's be honest, tough times are going to come. It's just a matter of when. How do you navigate yourself through that? Last year in Florida, we had a series of different hurricanes, and even in the Carolinas, where folks were devastated by unexpected events like the hurricanes that hit and caused flooding and lost homes and all kinds of financial challenges. you know how do you propose that you get to the other side of that? Are you prepared? Even if you're not prepared, are you starting to get prepared? My grandmother would always say every little makes much, and no matter where you feel that you are on that journey, the key thing is that to always put one foot forward, always improve day to day, moment to moment, and then get those around you that are also moving in that same direction. So discipline again is going to be critical. And then when it comes to savings versus investing, one of the key things that I've learned from one of my mentors is that, ultimately when we talk about savings, people think to, oh, the markets are up. Let me put some money into that. Oh, Bitcoin, oh, crypto, this. You have all these different marketing messages that are hitting you over and over again for how you can maximize a return. I get a 5% interest rate, a 6% interest rate, a 2% interest rate. You hear all these different financial terms over and over again, but the right kind of framework in order to actually make sure that it's working as part of your financial plan. So one of the key things that my mentor would share with me is that, Lauria, if you decide to invest in, this was back in the day when Apple was under $100 a share before multiple splits when it became amazing, or when you think of Amazon or any of these other stocks, or even the S&P 500 as a general a general predictor of the overall market condition. And he said that, Laura, if you can't save first, don't invest a penny. And I asked him why. He said, well, because you will make a decision today to invest, let's say, but if you don't have the requisite right habits and tools in place before you start investing, you can't keep committing to that investment decision. Investing is intended definitionally to be something for the long term. So if you're committing to something for the long term, you have to have things in place to make sure that you can actually ultimately commit to that long-term decision. It goes the same for relationships. It goes the same for your own belief system. All those things come down to, habits and attitudes, and even, your belief system to determine that you can actually do this for the long term. So becoming a saver first is going to be really, really critical before you dive into the investing space. And it's not that you can't do both and at the same time. However, you do have to make sure that you understand who you are first as a saver, how easy or how hard that is for you. And then you can then transition to then saying, okay, I have this habit down pat. I know what I need to do here. Therefore, let me go ahead and then dive into investing as well. Protecting assets are also something that gets a lot of kind of tricky language in the marketplace of ideas, because they're good protection products, i.e. insurance products, and not so good insurance products. Ultimately, your knowledge in the area of insurance will come down to truly having good information first, and then understanding where that product would sit within the bigger financial picture, and making sure that you have apples to apples transparent comparisons between what the alternatives are. And, not to do a shameless plug to myself, but I've learned over the years, having made some not so good decisions in the past, that it's a very simple process, and don't overcomplicate, what your insurance needs are. It's very simple based on a few questions being answered. All right. Now, the other thing that I want to talk through as well, and this kind of drives home the attitudes and the belief system that you have, is the principle of the sower. So giving back, in your unique way, is really, really critical as part of how you derive meaning from the financial gains and wins that you have. So perfect example is that, is it better, open question, maybe rhetorical, is it better to win by yourself and with no one around you, or to win with your community, right? Are you doing it just for you, or are you doing it for something bigger than yourself? I personally believe that the deepest meaning that you can derive in life comes from when you can serve others. So even as you're gaining momentum financially, and you're winning, and amazing things are happening for you, make sure that you're bringing other people along with you, right? Whether it's through your time, your talent, your treasure, make sure that that's definitely part of your long-term plan, because that's ultimately the legacy that you leave. We're all promised that we won't be here one day. However, what we leave behind is truly what the legacy is. So even though, yes, while we're here, we want to, to experience, joy and peace and safety and all the different things that any person would want, you want to make sure that ultimately that you're also thinking of something outside of just what you're dealing with in order to maximize that.
That's good.
Thank you. All right. Now, let me kind of dive into some numbers. I'm a numbers guy, ultimately. So I want you to kind of understand some things that we're seeing as it relates to the state of the American debt situation. And 53% of Americans are saying that they're living paycheck to paycheck. If that's you, definitely that just means that, hey, it's time to inspect under the hood. Let's see what we can do to incrementally improve moment by moment. 33% of people say that they're struggling and are in crisis with their money, and this is since the pandemic, since 2019. Food for thought. It's tough out here. So again, you know, joining a class like this and the series of classes that Royce and her team are providing, that's one of the first steps that you can do to start to change the narrative, to change your ultimate reality. It starts first with taking a first step. You know, more than half of millennials say that they have more debt than retirement savings. I'm a millennial, and I'm born in the early 80s. And, if you're in that age cohort, there's certain things milestone wise that you want to have in place. So if you're in that situation, it's time to have some intensity and urgency around, turning the tide on that on that statistic. The other thing too that doesn't get talked about as much is fraud. Now, I've been a victim of identity theft. I can't tell you how many times, how many services, but over 2.4 million Americans fell victim to fraud, with nearly $8.8 billion reported in losses. So making sure that you have a really good handle on your finances is not just about the money itself. It's also just about the awareness. So that way, when something doesn't look right, you're already immediately understanding like, I got a notification. I can't tell you how many times my wife will text me, was that you? Yes, that was me. Clicking the Amazon yes for the $23 sprinkler agent that I need for the lawn, for example. Or I went to the gas station. She goes to the gas station, and there could be an alert coming from my bank saying, "Hey, two gas station swipes at the same time or within a quick succession of each other. Is this correct?" That's the kind of responsiveness you'll need to have to continue to prevent yourself from being part of that 8.8 billion in fraud losses. In other words, you can't hide from your money. Talking openly about your money is critical so that way all of these things can then be put on the table and then effective strategies can be put into effect. Also, there was a study done very, very timely in as of Q1, which is between January and March of this year, where U.S. household debt is at an all-time high of 18.2 trillion dollars, and 4.06 trillion of that has occurred since the pandemic. Mortgages make up the largest portion of it at 12.8 trillion, and um, 1 in 5 families hold education installment loans, meaning student loans, with a median balance of 24,500. That in and of itself is sometimes necessary. However, making sure that you're managing the timing of when you enter into agreements is really, really critical. And you want to go in eyes wide open, buyer beware, consumer beware. And we're not victims. We're overcomers whenever it comes time for us to manage the responsibility. Some more numbers. On the student loan front, 45 million Americans owe about 1.56 trillion. It's a it's a big problem for a lot. And so, we have to make sure that we're dialed in terms of how we're going to have some debt reduction strategies. And I'll have some ideas later on in the presentation. Let me not be all doom and gloom. One of the things that really was heartening for me to hear when I was doing my research was that 83% of people who actually have a financial plan make real progress in one calendar year.
That's good stuff.
So just the step of doing the work of making a budget, sticking to it, yeah, like that's what it takes. It's not sexy. It's not easy. It's boring.
Yeah,
But the key thing is that if you do it over and over again, you're a sum of your decisions. So if you make consistently good decisions, good things will happen.
yeah.
If you sow in good ground, good will come. If you sow in not so good ground, it's not so good. It's very simple,
It cracks.
right? Okay. All right. Now, let me kind of switch gears a little bit and talk more from a banker's perspective. One of the things that gives me a lot of joy is when I meet different families, individuals, business owners in these four phases, and I'll kind of share kind of a quick little story on each one. So in the early phase or in the youth phase, this is where, you'll have like, let's say a teenager or somebody who's very young, new in the banking world, and you're introducing them to, concepts of banking. I know, everyone may probably agree with me that there's not enough information and literacy out there for our youth. And again, Royce and I are trying to be part
Yeah.
of the frontline charge to change that experience, to change to change that narrative. So typically, from a profile perspective, that person is typically establishing their first accounts. They're not going to really have limited, or they're going to have limited income or limited consistent income. Whether they're working a summer job, they work part time. They're really early in the process. But what I will tell you is that this is actually where you want to then lean in. If you have either someone that you know, or if this is you yourself, you want to get access to the education at this phase. The earlier you get the right foundation, the better it will be. And the reason why is because time is undefeated. So if you know that, for example, simple rule of savings. If you start saving at a very early age or have a consistent effort of having the right mindset to save from when you're very young, when you get older, now all of a sudden compounding and the time value of money starts to really make a huge difference. So if I were talking to my 15-year-old self, my 21-year-old self, my 25-year-old self, man, I would have said, no, put that extra dollar in. No, don't go to the fast food restaurant and get that extra burger. Or no, make a sandwich at home for lunch instead of going out to eat that one time. And a series of those small decisions would be transformational today, 21 years later in banking, for my financial picture. So remember that even if you feel like, oh, I don't have everything in order, no, 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 no. You are potential, you are able, you have the ability to really launch in a way that can be transformative down the road if you have the right things in place early. Next, I'll move to new families and working professionals. So typically, this is kind of like your mid 20s folks, maybe to early 30s. Typically, now they're establishing the first phase of their career. Maybe they're gaining some good work experience and they're receiving promotions. They're working really hard. It's grind mode time in this phase, right? If you're a business owner, you may be, trying to start a business, maybe you fail a couple of times and you come back again, and that resiliency is being forged in the fires of of competition. Uh, this is typically where the mindset of this group is. They're typically renting if they're not yet a homeowner, right? If they're getting it out the mud, they're going to have a lot of headwinds. So this is actually where you're forging the best habits that you can, so that way when it finally pops, man, the appreciation that you'll have for all the hard work that you put in, this is where it pays off. They may have some credit needs, and this is where I interject myself to make sure that I'm not just saying, "Oh yeah, you can get this, this credit product, for example, to to take care of that short term need or that longer term need." I'm actually also teaching responsible use of credit. Okay? If the individual is maybe getting married, or they're connecting resources with someone else, that's typically when that's happening as well. So you're growing a family, so you're pooling resources together, things like that. You want to definitely have someone that's in your corner helping you plan and really have a coherent strategy. And don't um, don't miss this point when you're introducing your own personal financial habit with somebody else's. That's one of the difficult steps when you're actually getting together. However, when you're, I don't know, if you're dating or things like that, this is when you want to have those conversations. I remember, really diving in and having some good healthy discussions around, well, what does the vision look like for the future financially for us? How does that look? What are your habits around money? You know, is it easy for you? Is it hard for you? Well, oh, well, I'm bad at this. You're good at that. Okay, great. And now we're starting to share and to weave together our lives, so that way together we know that we'll be stronger. Now, next phase, I'm just talking about established families and established businesses. This is kind of where the rubber is meeting the road. This is basically your best earning years. You're growing your business. You're establishing your career. You're starting to actually get momentum, and you're seeing the results through a lot of different key performance indicators. Let's say, right? Um, the largest credit needs are typically at this point because maybe you're taking care of young children and maybe aging parents at the same time. So you're being stretched. We call that the stretch generation, right? So whenever that's happening, you really need to be dialed in. This is actually when you'll make the biggest bang for your buck if you have things structured the right way. Okay? And then on the wealth management and the retirement front, this is kind of when you're on the other side of, that best earning years, and you're starting to think about, well, what's next, legacy wise? Do I transition my business or do I sell it? You know, am I giving my trust and my legacy to my children or to charitable organizations or both? You know, maybe depending on some financial difficulties that occurred throughout your adult life, you might be concerned about outliving your savings. You may need to kind of consider, well, how do I say I love you to my family by having my affairs in order so they can just focus on mourning, how amazing I was, wink, wink, versus trying to pick up the financial pieces. And, unfortunately, I've seen all too often where there's bickering, there's battles, there's issues that come about within family because the instructions weren't clear when you're no longer here. And I did not mean to rhyme. I apologize.
We have a question in the chat. It says, what are some recommendations on credit
Yeah.
monitoring systems and identity monitoring?
Great question. So typically, now, because you saw the stats on how much fraud is happening, what you'll find is that most banking institutions, credit unions, and others will have some kind of program automatically in place. So I would definitely reach out to your existing banking relationship and kind of inquire around that. Personally, I don't get anything for sharing, these two recommendations, but I've been tethered with Aura, AURA. That's one program that actually does yeah, like full monitoring services. I pay a monthly fee for that. It's not that much. It's a couple of bucks a month. But ultimately, it gives not just access to me knowing that my credit is being monitored and protected, but also in addition to the credit piece, also my email addresses and other places where my data is being fished all over the internet. They also have VPN services, so that way, as you're engaging in, let's say, your financial activity online, you have the ability to put some more encryption between you and the outside world with your financial picture and situation.
That's awesome.
Okay? Hope that helps.
Yeah. And Candace, I will also tell you, I don't know for your county, but I know we have it for Hillsborough, so I'll look it up. There is a way to sign up for alerts with anything regarding title. So, like if anything happens with the county and your name is involved in it, you will get an alert. So, like for example, I have an alert for me, and someone with a similar name popped up with some warranty deed or something like that, and it sent me an alert. And that's important because we have a lot of people whose houses are being stolen like that because they're sitting here filing different paperwork with the county and your name is attached and you don't even know that. So I will see if your county has that type of alert, but it's something you also want to sign up for too.
Yep, 100% agreement. Great question, Candace. Thank you. The nuts and bolts of stabilizing your budget. The emergency fund gets talked about probably, you know, just as much as anything these days, thankfully. But I want to kind of give you some key bullet points around what the emergency fund needs to do for you. Okay. And really how it should function as part of your bigger plan. So remember, what's happening every time is that when you get paid, there's revenue coming in or money coming into your coffers, and you have obligations financially that you need to meet, and then also you need to, to figure out a way to again spend less than you make. So step one is making sure that you create some barriers for that interruption of cash flow not to be a problem for you. So, step one, you're reviewing a budget to confirm that you are first spending less than you make, right? How do you make sure that continues consistently? Is that you're monitoring that spending very frequently, right? Calibrate and make the necessary adjustments that you need to in order to then truly have money that you can then say, okay, I'm pulling that away and that's going into my emergency fund. Automation. We talk about automation all the time for a whole bunch of other things, but one of the best disciplines is actually to make sure that it's just part of the routine. Now, notice that you have forced savings if you work a traditional 9 to 5, or if you're a W-2 earner, you have forced savings when it comes to Uncle Sam getting taxes pulled out of your check. Maybe you have a 401k plan. You'll have maybe an HSA. You'll have all kinds of deductions on that check where you see the gross number and then you see the net amount. Inside your bank account relationship, you need to also operate the same way. So that check comes into your account, and you have to use that discipline to make sure that you're automating savings. I do not care if it's $10, 25, 50, 100. I don't care what the number is. It needs to be in place because the behavior is actually just as critical as the dollar amount that is needed for you to meet or achieve your goal. Okay. Of course, a lot of times you hear the example of, $1,000, and I know there's also some battles online. I've watched some YouTube videos where they're like, "Oh, $1,000 doesn't pay for anything anymore," and that may be true, but it doesn't change the fact that you still need to have something to basically self-insure against small emergencies in life. I was driving down 41 in the industrial area, and a tire got well, a nail ran out into the road and found my tire and said hello. Okay, that's a couple $100 instantly. Where's that money going to come from if I don't have something in on the side outside of my usual normal cash flow that comes in and comes out? I need to separate that to the side to ensure that I can deal with that emergency and not borrow to meet that need. Okay.
So, quick question though, and I don't know if you're going to get to this. Well, I
Yep.
see it. You're getting to it.
Yep. We'll get there.
Yeah.
So, functionally, an emergency fund also needs to be away from the bills. Why? Because visually, if you're making these small decisions, and let's say you're on your path, you're on your process, you're making good decisions. Let's say it went from 40% of the time to 50 to 60 to 75. You're 90% making good decisions consistently. But then there's that 10% where, I want to buy that thing, or oh man, they teased me with another promo, and I can get it cheaper than yeah, even though I've been having that sit in my cart for 3 months. To avoid those kinds of impulse purchases, separating your emergency fund has to be part of the plan, so that way you're truly making sure that that money is going to be for that purpose and only that purpose. Okay. Now, after separating the funds into a separate account, then you can then calibrate it to make sure that number one, it's in a safe account, meaning on a you're not blowing this on a risky investment. So typically, you're looking for an insured account, something that's low risk, and potentially again earning some passive interest as well. Royce, go ahead.
I have two questions. So,
Yes.
when you say separate your account, like how far should we separate? Should it be in like a separate banking institution, or can it be with the same bank? Like, how hard should we have? Should it be hard for me to access that money? Like, how far of a distance does it need to be separate? And then two, are there specific types of savings accounts that we should use when we're just saving for an emergency fund?
Great. So great questions. Number one, it will always depend. Do you have the financial discipline to keep it at the same place, watch it grow, leave it to the side, you're watching it like paint drying, and you won't touch it? If that's not you and you can't do that, then you'll have to take whatever steps necessary to accomplish the goal. So if the goal is to make sure that that money is there for that, that nail saying hello to your tire, you have to then do whatever it takes to make sure that that's in place. Now, in terms of specific accounts, I will say that generally we're looking at usually FDIC insured or NCUA insured if you're at a credit union, those kinds of accounts. High yield savings are typically recommended a lot of the times because you know that the money is there and it typically won't be more than $250,000. So basically, you know that that money is also insured and protected, and then hopefully also making a decent return. But you cannot focus on the the interest rate or the growth of that account as the primary purpose of that account. You have other accounts to do that. The point of this account is to be there for the emergency. And That's a very, very difficult um, thing to kind of get around because the marketing is so strong that everyone feels that, oh, I have to maximize everything at every time, all the time, no matter what, because it's that consumerism mindset that we have. But to be honest with you, whether it earns a lot or a modest amount or a little, the point of the account is for it to be there for an emergency. Yes, it's always nice to earn the most that you can, and I'm not going to discourage that, but do not sacrifice the safety of the account for the return that you can get. Okay?
Thank you. That makes sense.
And then when we talk about, yep, and then when we talk about the right amount, most recommending as $1,000 for a starting point, like I mentioned earlier. But what I've found to be very helpful for a lot of folks to kind of put it really in kind of the right perspective, because this is something that they feel and live and breathe every day. Take the mortgage or the rent payment and count three of those, just like you would a security deposit when you were, getting a new apartment. You have to save for that anyway when you're getting it. So do the same thing for your emergency account. Save 3 to 6 months of the housing payments first, because God forbid, in a situation where there's a job loss, illness, or anything like that, what you're doing with this emergency fund is buying yourself time to be sober enough to make a good decision and not being frantic in the moment when life is lifing, right? So you start with 3 to 6 months of housing payments, and then once you get to that milestone, then transition to 3 to 6 months of living expenses, including the housing payments. So for some, that may be 5,000, 10,000, 15,000, whatever the number is, that that's kind of what you're working towards. And it's something that you're going to do in addition to all the other things that you're doing as well. So, however, if you're cash strapped or you're really tight on budget, you may have to just really have a laser focused on this in order to get there as quickly as possible. And then once you get to maybe the first milestone or the second milestone, then you can kind of put it on an automated plan again, and then keep going towards the larger goal while you address something else. Okay? Now let's switch gears from savings to debts. Okay? So in the debt management space, budgeting and saving is really the main way that you are able to get through the debt cycle properly. Making extra payments obviously is how you can pay down debts faster, which is how you pay less interest. Debt consolidation is kind of a mini hack where you can consolidate multiple accounts into one account with one payment, and then that basically gives you more of a visual key to kind of understand, well, once I have this one debt and I see it in a lump sum, now I can see a date certain or a time certain that I can get this completed. Or you can increase income to be able to afford an increase in costs. Some common debt reduction strategies include the avalanche method, snowball method, paying on a faster frequency, um, or also debt consolidation. Okay. Um, 1 second, Royce. I'll be right back. 1 second. You do it on paper. That's different.
Sorry, I
That's
apologize.
different. Yeah, just okay. Yeah, that's different than when you're doing it through an app or through automation, right? So what I would say is that I don't have like a specific platform that I would recommend one over the other, but I just know that the methods do work, and To be honest with you, I'm more of the old school type where I think that putting it down on paper, especially the first time around, it really forces to kind of pull the information away from the digital world, put it in physical reality. And there's something psychologically that happens when you're actually wrestling with what it actually says and what you need to do with that.
That's good
So
advice.
I, for that method, honestly, uh, yeah, that's what I've personally done in the past, especially with like my student loans and things like that. And it really helped me with my intensity around putting things in place and getting it tackled and getting it kind of gone fully, out of my life because I was able to kind of wrestle with some things and what the implications were, how it basically hamstrung some of my short-term and long-term goals because it was there. And so it became a constant friend, really a foe. And from there, I was able to really lock in and get it tackled. So
Yeah.
I personally believe in the paper method, honestly, with that. Now, from a budget perspective, I also have a similar attitude around that where once you have it on paper, what it will do when you write it out on paper, it becomes a snapshot, and then you'll have more like a forecast versus actual situation. And each month, when you're kind of looking at it, you'll kind of know, I didn't, I hit the milestone or I didn't hit the milestone. And then now, a lot of the banking platforms already have it integrated that as the transactions are hitting the account, you can categorize them automatically, and you'll know really what your budget number is. That's kind of what I personally use right now. And it's sufficient for what I'm trying to handle because I'm still doing it on paper and I'm just using the online tool to verify, what I have on paper.
We missed it. I think it cut out when you said what tool you're using for your budgeting.
No, yeah, I said I use paper and then the banking app
Okay.
automatically does like the categorization. So as the transactions are hitting, whether it's on the account or on a credit card, I categorize all of that and then it just confirms what the budget was supposed to be in the first place,
Gotcha. Thank you.
right? I want to add another thing to the debt consolidation topic specifically. Uh, I used to be an underwriter as well, and what I found is that sometimes, folks who, let's say they're in the phase of kind of their best earning years, they use the debt consolidation tool as a bailout plan because they know that they're making, sufficient money to afford to do that. So I want to be very cautious when we're talking about this as a strategy because while the math of it absolutely works when done correctly, where you're taking high interest on debts, consolidated into one balance with a lower rate, obviously there's going to be cost savings in that. But my concern sometimes when that's happening is has the lesson of runaway expenses been learned? So are we really meeting the belief system that we're truly spending less than what we make? So a lot of times when folks are in consolidation situations, it's because they spent more than they made for whatever period of time or whatever cycle time that was, and now they're looking to be rescued from that situation with this consolidation because again the math does work. So while it is a tool, it is a strategy, I'm always interested in making sure that the person's mindset that's actually going through that process of getting that consolidation loan done, that they're really on the right temperamental path, not just the right financial path. Okay.
Makes sense for sure.
Yeah. Okay. Right. Last couple of slides. I'm almost done. Um, I wanted to talk about also what I call the cash management structure. So I'd like this because it's a good visual to kind of help you understand what's actually happening with your money when you receive it. So for an individual, no different than a business, money comes in, like I said, we're drilling down into, okay, I got to pay the bills, talking to mortgage, utilities, phone, transportation, things like that. But then there's also discretionary needs, like, oh, well, not needs, but discretionary wants, like your vacations and movies and things that are not really a need, but it's a want. And so this is kind of where that mental battle has to take place as early as possible to make sure that you know what a need is versus what a want is. And this is, again, one of the root causes sometimes of when runaway expenses occur. No, the Starbucks run is not a need. I don't care how you want to say it. I don't care how you want to craft it. We're really good at justifying anything. It truly isn't a need because there is an alternative that's cheaper. Okay. Um, Now, once we've kind of battled with, you know, the needs versus the wants conversation, then now we can start talking about, well, yes, congratulations, I'm spending less than I make. So then where does that extra money go? Well, I'm looking at my short-term savings, and that's where that emergency fund that we just talked about in great detail, that's where that comes in. And then also any funds that you need in less than 1 year. That's all considered short-term savings. So my best practice is to make sure that if you're going to try to buy something that's more than what your typical bills are, to start saving for it. Feel the payment of what that would cost ahead of time and keep it to yourself first. And then once that happens, let's say you get 50% of the way there, 75% of the way there, do you still want that thing? Because it's not a need, it's a want. And then if that's still the case, then great. You've saved most of the money, and then this is how you can stay out of the debt trap, right? Now, once that's really running and humming on all cylinders and firing on all cylinders, this is now where your savings discipline is healthy and strong. You know, you have excess cash, and then now we're talking about, you know, retirement, pensions, investments, and basically any kind of savings amount that's needed longer than 1 year from now. Okay. So a lot of people, of course, already have great savings, options as it relates to if you're gainfully employed, for example, you can do that. If you're a business owner, you have to self-fund that, and there's all kinds of tools and resources, strategies that can be put in place that we can talk, offline about. But ultimately, that's how simple it looks when it comes to your cash. If you get extra money, you filter it through that same cycle, that same system. If things are tight, you filter it through that same system. But it's the discipline of doing this over and over again, day in, day out, make it boring. That's actually how the compound effect of money, how the time value of money actually then truly works miracles. Okay. Okay. And then when it comes to types of accounts that would work in those three different phases, typically you're talking about checking, savings, high yield savings, money markets. These are accounts that would be available to withdraw from each and every day. Of course, there's rules to savings accounts where they limit the amount of withdrawals that you can do intentionally because the goal of the account is to save. Whereas checking accounts, there's typically unlimited transactions allowed on that account. In terms of short-term savings, depending on your unique situation, you'll have the same three accounts available to you, but then you'll also have CDs or what's called a time deposit, where basically you're giving the bank a loan. Whether it's here's $10,000, I expect to earn a 3.5% interest rate over 12 months, as an example. Okay. Short-term bonds and treasuries function roughly the same way like a time deposit. It's just not FDIC insured. That's the difference. And then long-term savings, typically you're talking about some kind of cash account, money market funds, also treasuries, bonds, and then IRAs, CDs, and brokerage accounts are all going to be lumped kind of in that pool of long-term savings. But I'm not a financial advisor. Put that on Front Street. So I recommend that you talk to a licensed financial professional that can aid you with making those long-term savings decisions. But the principle of long-term savings, that's something that I can definitely speak to from personal experience and professional experience that it is one of the key legs in building financial wealth. Okay. And then last but not least, here's a visual of kind of what your account structure could look like. So visually, think of it again. Short-term savings are going to be in the savings brokerage space. Operating cash is going to be that checking account typically, and sometimes it overlaps into savings. And then retirement is going to be more of the long term. Now, to aid you with making sure that the left side is successful, if you're responsibly using the right side, which would be credit card, which is really for short term, that's why I put it in the same line as a checking account. An installment loan or line of credit would be more in that medium medium term, let's say, and then the mortgage is typically going to be something that's a longer term because it's usually the biggest balance that you would borrow. Those are the three kind of main areas of credit or lending that you'd be engaging uh, in those situations. And then insurance products are really what underpins the protection of the whole operation. So that's why it also sits at the bottom. Any questions?
No, that was pretty good. Definitely. Can you go back to the last slide? I think I had a question on that one. So, as far when you say short-term bonds and treasuries, if we're looking at a comparison like 3.5% to a high yield savings account, I guess you would kind of weigh your option or whether you put it in the short-term bond world versus a high yield based on the interest rate that you would get.
Well, it's a combination of things. Remember the regular savings high yield savings or money market accounts are typically FDIC insured.
Mm-hmm.
The short term bonds, treasuries are typically not FDIC insured or NCUA insured for that matter. So that's one component of the distinction between the two.
Mm-hmm.
Also, the while rates are always going to be adjusting and changing in both spaces, it just depends on sometimes the dollar amount that you're putting in, the type of account structure that you agree on with your financial planner. Um, those are some of the things that really govern the choice that you make between one versus the other. And then also you have to think through the fact that um, for most people, the recommendation will typically come from some kind of risk assessment of what they're comfortable investing in versus not investing in, and that will help guide their decisions as well.
Got you. Do you see a lot of people still doing, I mean, even given the, and I know you're not a financial advisor, so let's be clear, he said that, but I'm asking a question. Do you feel like a lot of people still do those types of investments or savings strategies when it comes to the short-term bonds, being that it's not FDIC protected?
Yeah, at times it just depends on their situation. Typically, what happens is that the speed at which they're looking to get a return and also what's available to them in terms of what kind of account structure they have will also govern which way they go.
Got
So if you're just an individual like a regular person like you and I, we typically stick in the FDIC space for the most part. But if you're investing, if it's part of a bigger strategy, then that could be part of the plan because when you're thinking about the percentage of what you're choosing one versus the other, your financial advisor or planner will dictate based on a series of questions that they ask you, understanding exactly how the accounts perform historically and ultimately predicting well they can't predict, but what they expect potentially in the future. That's how they actually come up with the decisions that they do, and then they give you the rationale for why you choose one thing versus the other. But absolutely, they're in play
Gotcha.
because typically they're going to be safer than traditionally investing in a company that's on the stock exchange, as an example.
Makes sense. Gotcha.
So it's just levels of risk being analyzed.
That's good. No, very informative. I love that.
Any other questions?
Not that I can think of. I know I'm going to be reaching out to you with some more personal stuff, but none regarding the presentation.
Okay.
Do you
All
have
right. Well, I just want to say thank you so much again for, sorry,
no, go ahead. It's a delay.
I was going to say thank you again for, okay, yeah. Thank you so much for just allowing me to share, kind of a little piece of my world. Again, my goal here is not um, to it's not to make it seem like, oh my goodness, this is so hard or so difficult. It's to make it approachable, share the truth of exactly what banking can be, and then share with you how you can navigate, all the different stages and steps along the way. Um, I will, I think I want to come up with like a questionnaire of some questions that you want to ask your banker, um, you know, as almost like as a key takeaway, so that way you can inspect or evaluate your banking relationships, and then from there, I would then use that as kind of one of your guiding tools or guiding principles to help uh, make yourself become a more savvy banker or a banking client.
Awesome. No, that would be very helpful and much appreciated for sure. Well, thank you so much for being
Sure.
here and imparting on us so much of valuable information, things that I didn't even think that I needed to know. My favorite piece of what you shared, and I think I'm going to definitely re-mention that, is this. Oh, we have a person coming in, Marjorie. One of my favorite pieces that you talked about in your presentation was if there's something big that you want to purchase and you know how much it's going to cost you monthly to go ahead and start saving and putting that money to the side so you can start to feel that payment. And I'm definitely going to share that with my community because I think that is mind blowing. That's like for even buying a house. Like if you have someone who is planning to pay 2,500 and maybe they're only paying 2,100 in rent, save the extra 400 just to kind of see how it feels when you're going to be making that payment. I think that was like mind blowing that you said that. I think that was really like great. So I really want to thank you for taking the time out. For anyone that has registered, I am going to send them your information, but do you have a slide that has your information on there? If not, you do?
No, I don't have one on this presentation,
Yeah. So,
but I can absolutely give the information at the end if you want
yes.
to email it out or
Yeah, we're going to email it out. So if anyone wants to schedule a consultation with Lauria, definitely feel free to do so. He's amazing. First Citizens Bank is amazing. They're a family or owned business and they have that relationship feel. You're not just gonna like like you go on Walmart, you're bagging your own groceries, you're scanning it. Like that's not happening at First Citizens Bank. Like you have actual people working with you. So you're going to get that feel. You're going to get the customer service that you deserve and all of the information you need for your specific needs. Um, for everyone, I have a lot of people that's joining late right now. It's no worries, no worries. We are pretty much done with our presentation now, but I will send out the replay only to the people who have registered because this is, you know, restricted information. So we want to make sure that we get it to the through the proper channel. So those of you who have registered, I will send it out to you later, so that you can rewatch the presentation and get all the gems that Lauria dropped in. We will have more presentations done by him later on in the year. So he's definitely amazing. For those of you who are interested, our next class is actually this Thursday. And that class will be led by a financial advisor, and he'll be covering his topic will be how money works with Kenneth Taylor, and he is with Wealthway Financial. That will be held at 12 p.m. Those of you again who register will have access to the replay, but that will also be something that will be great as far as a continuation to this class because we just learned about banking and all of those tools. And so now we'll have a little bit more information as far as learning how to invest that money. Once we get that savings and budgeting down pack, right? So thank you again, Lauria. I'm going to send
That's
out his
right.
contact information. So if you want to register or schedule a consultation call with him, feel free. He's also located in Tampa. He's over there by Top Golf. So if you want to just go visit him and see him in person, you can make those arrangements. Do I have any questions? I mean, he's here now, so I don't know if anyone who just joined has specific questions that you were wanting to know about banking while we have him here. We have 3 more minutes. And welcome, Marjorie and Angela. No questions?
I will say too that yeah, I will say also that I'm okay with also meeting virtually. I do use Microsoft Teams, so feel free that it's not going to be an issue if you're working in Tampa and can't get to the office within our business hours. I do a lot of virtual meetings, which is super convenient a lot of the time. So I'm happy to do that as well. And typically, most of the consults that I do are going to be about 30 minutes initially, and then we can dive into something deeper in a 1 hour session. So just I'm here. I'm open to talk about anything. And if I don't have the answer, do know that I will always leverage my network, the resources, and the tools that are behind me to do that.
Yes, there will be a replay link. I'm going to send it out
Marjorie, yes.
today. Mm-hmm. You will get the replay. And then also I'll send out Lauria's information so you can schedule a meeting whichever way is convenient for you, virtually or in person or on a call. You can do all of that.
Absolutely.
And if you have questions, just feel free to ask him. But again, our
Yeah.
next class is next Thursday. So I did put the link in there for the class schedule. So feel free to register for any class that you want. I will be adding more. This is just through July 14th, but we will have more classes. So keep an eye out for that. You're welcome. Well, thank you all for being here today. Thank you, Lauria, again for all of the amazing information. I am so excited to put some of these strategies into play and can't wait to have you back.
Thank you. I appreciate it. Thank you all.
Happy Monday. See you guys
Happy
later.
Monday.